Gosh dang it, Tom Lee was correct again. They alerted their Fundstrat members last night after Nvidia's earnings about this. They say, will Nvidia weak reaction post EPS trigger rotation or risk off? Given AI related spend is intact, the case is stronger for rotation into cyclicals and small caps, not risk off. Many will expect the broader market to sell off post Nvidia's EPS, but we don't. And I'll be damned, that's exactly what happened today. As Nvidia is down 3.5%, all of your other big tech stocks are soaring higher, like 2.5% on Apple, Meta's up 1.6%, Amazon's up 1.8%, Google's up 1.4%, Microsoft up 2%, and that's just big tech. Even if you look at the RSP, which is the equal weight S&P, so not the market cap weighted S&P, the RSP is up 0.8%. It's actually matching, damn near matching, the market cap weighted S&P. So you are seeing a broadening out of our markets. And this is really something that nobody was expecting last night following Nvidia's earnings, and as futures were down 0.5%. Now, it's not just Nvidia earnings, while Nvidia is selling off, allowing $100 billion of market cap value to make its way into other areas of our markets, definitely can be seen as a positive for the broadening out thesis of markets. It was really the economic data today that caused markets to internally roar higher. And no, it was not the worst pending home sales in history that came in at negative 5.5% in July. Like literally, we've never seen pending home sales this low ever in the history of this country. I do actually think when the Fed does start to cut rates and we get maybe 1% worth of cuts in the books, I do think there's a lot of equity in people's homes. As long as we are not going into some kind of employment recession, then you're probably going to see people start to sell their homes more, buy new homes. And when they sell their homes, they're going to get potentially hundreds of thousands of dollars in the bank. And that can be very stimulative for the economy. So if you're looking for an upside surprise to consumer spending behaviors, to personal spending, I think once the real estate market starts to not even recover, like the price of homes can stay the same, but once you start to see more turnover, more churn in the real estate market, that's potentially an upside surprise to economic activity. But it doesn't look like that is happening right now. So that's one of those things where it's so bad that if it gets better, that's going to be really good for the economy. With that said, what really caused investors to get excited today was the upward revision to Q2 GDP. Just like any other data point that comes out, there's 3 revisions. We get the initial number, and then the next month it's revised, and then the next month it's revised again. Now, GDP for the first estimate we got was 2.8%. Great. We were expecting 2.8% again for the second revision. We came in at 3%. So GDP for Q2 looks like it was stronger than we thought. Now that's great. Wall Street tries to kind of extrapolate that, meaning that last quarter was good, so that means this quarter is going to be good or better than maybe we think. And I don't think that's necessarily true. I don't think you can look at last quarter and say that means this quarter is going to be good, but that's what Wall Street does, and that's exciting for investors. Initial jobless claims, I think, was another, very positive event today. Initial jobless claims came in at 231,000. We were expecting 232,000. So you actually came in lower than expected. And initial jobless claims is the highest frequency data that we get, meaning if something's going to go wrong in the labor market, odds are initial jobless claims are going to reflect that before we get non-farm payrolls, a more lagged indicator of the labor market. So this initial jobless claims today, upon the others that we have had in recent weeks, suggest that we're probably doing just fine, at least right now. Retail inventories, excluding autos month over month, came in at 0.5%. The previous month was 0.3%. So I do think some of the upwards revision to GDP does have to do with inventories. And if you guys want to provide some further clarity on that down below in the comment section, be my guest. And again, as we already mentioned, pending home sales came out at 10 o'clock in the morning today at negative 5.5%. You were actually expecting a positive number here, a positive 0.4%. So that was kind of a big disappointment. Pending home sales year over year came in at negative 8.5%. You were expecting negative 1%. Things are just getting worse in the real estate market. Now at 3:30 p.m. today, we will get some comments from Fed Bostic. And if he has something to say the markets do not like or they do like, that could definitely have an impact towards the end of the day today. Fed Barkin said today, inflation down. We're not there yet, but we're making progress. Now today makes things really complicated because we're heading into September, which over the past 10 years is by far the worst month for stocks. Over the last 10 years, September on average is down 2.6% for the S&P 500. That's by far the worst month. The only other month that is negative at all is December, and that's negative 0.2%. So you are almost 15 times worse in September than December, which is also another red month. So it's really bad, okay? The last 4 years, 2020 was negative 4.1%, 2021 was negative 5.0%, 2022 was negative 9.6%, and 2023 was negative 5.1%. So what are we gonna get this September? Well, hard to say. But historically, it's easy to say September is a pretty bad month for markets. And at this point, heading into the first Fed rate cut, it's all about the economy and it's all about the labor market. That's what is going to dictate what happens next for stocks. Because again, we are priced for perfection. So any weakness is gonna be seen as really bad news. Take a listen to this clip from CNBC that says all eyes are on the labor market now. It says Empower Investments, Martin Norton.
Markets, let's bring in Marta Norton, Chief Investment Strategist at Empower Investments, a unit of Empower, which has more than $1.6 trillion with a T dollars in assets under management. Marta, thanks so much for joining us. So what do you make of the setup from NVIDIA last night and how markets are reacting this morning? Where should investors go from here?
Yeah, it's really interesting. I mean, there's no question that the reaction around NVIDIA, with NVIDIA beating expectations in most cases, is more sentiment driven than it is fundamental driven. When we have a stock like this and really a movement like this with AI, where there's so much enthusiasm behind it, it's really not much surprise that when results aren't picture perfect, there's going to be a bit of volatility around it. So I think that's more of a sentiment thing than a fundamental thing. I think the larger questions around AI that relate to transferring this CapEx spend that we're seeing into actual revenue and efficiency gains, I think that question is something that the markets are going to have to grapple with for quite some time.
Yeah, and it's almost kind of just a sigh of relief. Okay, yeah, they didn't beat wildly on the upside, but we know that the basic thesis about AI is still intact. What do you think the next big question for investors will be over the next few weeks now that we've sort of gotten over the NVIDIA hurdle?
Right. Well, I think with NVIDIA behind us, I think all eyes go to jobs. The Fed and Chairman Powell in the speech in Jackson Hole made very clear that the mandate has shifted. We've moved our eyes from inflation and, in fact, really declaring that that battle has been won and really turning focus onto the labor market. So I think as we start to see these jobs numbers come through in September, I think that's where the focus is, and that's really where expectations are going to be established for what the Fed does later in the month.
Yeah, and along with jobs, of course, a lot of focus on the consumer and some recent consumer names reporting like Foot Locker. Where do you see the consumer right now, and what are we learning from the earnings report on the ground about which types of consumers are struggling right now, where we could see some strength?
You know, it's really interesting with what we see with retail earnings, and that results in large part mirrored a broader earnings season that was largely positive. but it's almost boilerplate commentary in a lot of these retail earnings to talk about an uncertain future, a consumer who is more discerning, who's more value oriented, and seeing some bifurcation, which is something that folks have been talking about for quite some time, between the lower income and the upper income. And so I think this idea of discernment of a consumer who's more under pressure, a lot of folks are pointing to the idea that excess savings that we received from the pandemic have largely been used up. So I think this idea that the consumer is going to face a little bit more pressure and is going to be a little bit more in the epicenter of concern is something that markets will continue to think about.
And Marta, related to that, the market as a whole, if you look at the S&P 500, it's had this strong comeback from that pullback of 10% correction just about that we had culminating a few weeks ago. But the composition of the gains has been a little bit different. I mean, semiconductors are still 15% below their highs, even with the S&P within about 1% of its highs. It's been a little more maybe defensive, rate-sensitive names working. Do you see that as a potential, longer-term leadership shift, things like healthcare working, or do you feel like that's just a passing phase?
It strikes me that a lot of the S&P, the 493 stocks outside of the Magnificent Seven, have something that those stocks don't have, and that's valuation on their side. So while we have the Magnificent Seven type, the NVIDIA and its friends, that are at high valuations, not sky high, but high valuations, and then you have the rest of the market that is really trading at kind of fair value. I think we're, well positioned to see that area produce. Now, I think the exciting thing about the rest of the market is that you have both cyclical and defensive stocks at reasonable prices. And I think these two areas can do well in different kind of economic outcomes. You have areas like small caps that can do very well if we're in a soft landing narrative and we have Fed cuts on our side. And then you have areas like, as you mentioned, healthcare or consumer staples that tend to be those defensive go-tos. And those can be great places to hide should we see, markets and the economy disappoint a bit more. So I think it's great that investors can really introduce optionality into their portfolio and kind of position for a range of market environment.
And I don't know if you've seen it on screen, but we have another consumer name that got sent to the wolves today. And the wolves ravished Dollar General. Dollar General is down over 29% today at the time of recording this video. That follows really a bad 2 years or so now for Dollar General. And this thing just cannot catch a break, hitting its lowest levels you have seen since 2018, 2017, briefly in 2016. And Dollar General's really value, okay? Dollar General is not, Dollar General is like a smaller version of Walmart, okay? Lots of value resides in a lot of Dollar General's items. And if Dollar General is not doing well, I struggle with the bull thesis, broadly speaking, in markets. Now today here in After Hours, we will get earnings from Dell, Lululemon, Ulta Beauty, Marvell, Gap, Autodesk, and MongoDB. Tomorrow morning, we will get Frontline, First Solar, and Miniso. Treasury yields today are up about 2.5 basis points to 3.86%. And yeah, the 2 and 10-year yield curve is uninverting now at a rapid pace. On August 19th, you were inverted 20 basis points, and today you're only inverted 2 basis points. Now, historically, when you get the 2 and 10 year that uninverts, well, what happens? You historically go into a recession. Now, most inversions do not last this long. This is the longest inversion on record. Usually they can be short-lived, they can be brief, and then you uninvert, and then usually within the next couple of months, you go into a recession. So this is the all-time historical precedence of this since 1976. Every time you have went inverted, you have went into a recession. And every recession has had an inverted yield curve. You may even say 2020, well, that didn't have an inverted yield curve. Yeah, it did. Actually, in August of 2019, it briefly went inverted only for a couple of days. And at that time, Who would have suspected the Rona was coming? Someone in the bond market did, that's for sure. So you're now almost uninverted. Well, actually, oh crap. So I stand corrected. As of yesterday, you were actually positive on the yield curve, 1 basis point, 1 point. And now you're actually negative again. So you're right there, borderline uninverted, not uninverted, briefly being uninverted. But it's really when you start to materially uninvert when you go into the recession. Okay. Now, this does have to do typically with the Fed cutting cycle. Okay, when you uninvert, that just shouldn't happen. You should not get paid more for investing your money for 2 years rather than investing your money for 10 years. What that means is over the next 10-year period, investors expect lower returns, right? Lower economic activity and lower federal funds rates. Because normally if the Fed's raising rates, that's because the economy's doing well and there's inflation, right? So that makes sense. It's when you uninvert is historically when the 2-year falls and 10-year holds up in yield, or maybe falls, but not as fast as the 2-year. And then you get this uninversion. Well, that normally happens when the Fed is cutting rates, or at least starting the process of cutting rates. We're not there yet, but the markets are pricing in already substantial cuts from the Fed, and that is the main reason why the yield curve is uninverting. Again, historically, when the Fed is cutting rates, you do go into a recession. You know, it doesn't have to mean we're destined for a recession, but even like you've seen in 1995, I mean, the yield curve, this was the only soft landing we ever had. And the yield curve did not invert, right? The yield curve stayed positive this entire time. And that's why people pay a lot of attention to the yield curve, because it's just a foolproof kind of way of gauging, at least so far, whether or not we're going into a recession. And from my perspective, with the seasonal weakness we get in September, if we start to get economic data that looks worse, that's going to be an even bigger problem for markets. Although I do think the economy is much worse than the data shows, I think there's a 3 to 6 month delay in the data that we're actually getting. So what we're seeing in the economy now will be reflected 3 to 6 months from now. And we could very well be in a recession now, but not even know for 3 to 6 months because of how lagged behind the data is. Some things get captured in the data, some things do not get captured in the data, and it takes a long time for the markets to actually get an accurate representation of what's going on in the economy in real time. So from that standpoint, I don't think September has to be a bad month for stocks. I don't even think October needs to be a bad month for stocks. We obviously have election risks coming up. Seasonal risks in September definitely are historically not good. But other than that, the data we're getting is pretty good. The consumer looks to be holding up. Again, I think we're seeing data from the economy 3 to 6 months ago. So the consumer was a little bit better then, right? And my many businesses outside of YouTube or financial markets is where I'm drawing that conclusion from, okay? People were doing better 6 months ago. And I think that's the picture that we're being painted today. So in the medium term for our markets, the next 6, 12 plus months, at some point, I think it's going to get worse. At some point, I think we're going to be faced with that recession fear or an outright recession. I think there's a 60% plus chance of that. But in the very near term, I don't think the house is falling apart. I don't think we need to see some epic big disaster in the month of September. Whether or not election fears come in or other things happen, obviously I can't forecast that. But I do think as of right now, cash is king, and you want to be ready for a larger pullback in markets, but you also want to be positioned in cyclicals and small caps in other areas besides big tech that can do well if the markets are convinced the Fed is cutting rates and we are going to get a soft landing. I don't think you want to miss out on that opportunity just because recession risks, in my opinion, are 60-65%. Like the last thing you would want to do is not participate in our markets, watch everything roar higher, and we never go into a recession. Again, I think that is unlikely. It is a possibility. But the last place I want to be right now is big tech. I basically like everything else besides big tech. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.